Okay. Hello, good. Sorry. Unmute. Okay. Good evening, everyone. We trust you all are having a delightful evening. Alright, okay. Tonight we have a privilege of welcoming Mr. Daniel Ang for a discussion on transition to futures. It's my pleasure to introduce Mr. Daniel Ang, who embarked on his journey in commodity futures trading back in 1985, notably navigating through the 1987 market crash with early success. Following his tenure with major brokerage firm, Mr. Ang transitioned to full-time trading in 2006. While in 2012, he established Traders Academy International, focusing on coaching and speaking engagements. Alright, now, the agenda for today's section would be presented by Mr. Daniel, includes insights into, firstly, the state of the US and global economy, market outlook for US equity, and also gold market insights, nevertheless, introduction to CME Group Micro Series products. And also we would actually have a live section trading section, a real-time learning with Mr. Ang. And also Mr. Ang is not only an active trader, mentor and author, but also sought after speaker for international exchange and FX brokers. Notably, he recently delivered a keynote presentation on gold for a multi-jurisdiction FX broker in Singapore. Without further ado, Mr. Ang would speak on transition to futures. Okay, Mr. Ang.
Thank you very much for the kind introduction. My name is Daniel Ang. I have been around the block a few times. I think by next year, I'll be celebrating my 40th year in this business. So I have certain views, and I hope you will find them very interesting. Like what has been mentioned, I had the good fortune of having very early success in my career. I actually stumbled into trading from a very young age when I have no idea what I'm going to do as a career. It so happens that I have a classmate who's going for a job interview, and he asked me to tag along just to accompany him. And one thing leads to another. I end up in this business. And I also somehow managed to make my first pot of gold. Also by luck, not because I'm very skillful. In my early days back in 1987, I believe I'm one of the very few that actually caught the entire market collapse back in 1987, what they call Black Monday. Okay, and I was selling the Hang Seng Index futures. So I have started my career trading futures. So I did not have the good fortune of trading equities when I started. So I have never looked at equity trading because I thought futures is actually quite a lot more interesting than trading equities, because equities are basically long buyers. You can only make money by buying, right? So only if the value or whatever you bought continue to rise in prices, then of course you can be profitable. But we all know what goes up eventually will come down. And in equity trading, I find that there is that handicap in the sense that you cannot profit from a falling market. But I do not have the same issue with futures contracts. Okay, so futures, you can actually have a bearish view, you can have a bullish view. They allow you to both to go long as well as to go short. There is no restriction. For equity trading, the many exchanges do put in a lot of very severe restriction for short selling. So that to me is actually a handicap. So I have always find trading derivative products like futures having more suitable to my outlook. Okay, so today I'm going to give you a brief outline of what I think the market is doing of late, and in particularly to equity index futures, because this is one of the most successful futures contract ever designed. Okay, I have a good fortune of trading the S&P 500, the big one, In those days, when I started the S&P 500 trading, we only have the S&P 500. There was no such thing as E-mini or definitely no micro E-mini. So in those days, the notional value was a lot lower. That's why we can trade those products. But as times evolve, we have seen the equity market has been rallying. In fact, up to Monday itself, we can see that market has been trading into fresh all-time highs. So this is where we are right now. The market is very, very bullish. And will anything change? And how can you take advantage of this market volatility, which is something I'm going to talk about over the next two presentations. This presentation is actually broken down into two parts. Today, I will be talking about giving you an overview of what the markets are doing and what is driving markets higher, and of course how you can use the CME Micro E-mini equity index futures to actually take advantage of this market volatility, as well as gold. Gold this week has again traded to a fresh all-time high. So this is also something that is very, very hot right now. How you can also take advantage of gold prices going forward, and what are my views. In the second part of this presentation, which will be held the same time next Thursday, I will be talking about technical analysis, and it will involve something more interesting because it will involve live trading. So I will check you in from what I think market should be what you should be looking at in terms of using the various tools available for somebody who are very keen to use technical analysis to actually analyze and take a position in the markets, and how I execute those trades in a live environment. I hope that will be very interesting for you. So, okay, guys, without much ado, let's get into the content proper itself. Before we go into the content itself, I want to remind you guys that this presentation is definitely not a offer to buy or sell any kind of securities, be it futures, options, okay? And it should not be construed as investment advice. And the trading of any kind of leverage products like futures and options do carry risk, so do understand your own risk tolerance before you attempt to trade any kind of margin products. And of course, I'll be sharing with you my views on the various markets, what I think markets are, what is driving the markets basically, and those are my views. And if I do give you a broad directional bias of where I think market is heading, those are my views, and you should not trade those views based on what I say. You have to do your own homework and do your own analysis before you actually attempt to trade, and therefore I shall not be holding any responsible for any action that you may take. Now, of course, those views are my views, got nothing to do with the sponsor, which is Apex Security Berhad, as well as the sponsor for tonight's event, which is the CME Group. Obviously, we will not be responsible for any action that you may take here. And of course, the content here has not been vetted by the Security Commission of Malaysia, so do take that into consideration when you are listening to this presentation. Now, with that out of the way, let's get started. Okay, we knew that the market of late, since the last quarter of 2023, has been led by the tech stock rally, and we heard about these companies called the Seven Magnificent. Because we have Meta, we have Apple, we have Amazon. Those are the companies, the big cap tech companies that have been leading the market higher. Now, if I can backtrack a little bit, going into 2022, within 48 hours of the market opening in 2022, the market peaks in the S&P 500 as well as in the Dow. Okay, of course, the Nasdaq already peaked 2 months before that. It actually peaked in November of 2021, but the S&P 500 and the Nasdaq actually peaked within the first 2 trading days of 2022, and the market actually went down for 3 quarters consecutively, and only bottoms out in the last quarter of 2022. And you can see the market has bounced, okay, and this bounce has taken markets to where it is currently. As of Monday itself, we can see that at the beginning of this week, the S&P 500 and the Nasdaq 100 has all registered fresh all-time high. The only index that has not registered all-time high this week itself has been the Dow Jones. Later on, I will explain to you why the various equity index have their own personality and what it means to market participants. And as a retail trader, which are the index we should be relating to as far as sentiments are concerned? Okay, so we can see overall equity markets in the States has actually gone up, and then you can see this is the latest price as of this morning itself, and I can see that market has been on this trajectory going higher. So this is where we are right now. Market is very, very bullish, and we are beginning to see some signs of some kind of light profit taking. So for the time being, I can only classify them as profit taking. There is no imminent sign of a collapse, because everybody's talking about, if prices are so high, is it in danger of unraveling? Of course, the risk is always there, okay? And we cannot totally dispel the possibility of a big counter trend move. But for the time being, technically, at least this is what I think is happening. I don't think that it's going to be a major collapse coming. But I am not ruling out at least a temporary top being in place, and we probably will see some kind of profit taking going into the next 2 months of trading. Okay, so this will be the overall outlook. And if you have any question, leave your question to the very last, because at the end of the presentation itself, before I wrap up my presentation, there will be a Q&A session. So I will love for you guys to be more proactive, put your question into the chat itself, so that we can address them at the end of this presentation. Okay. Now, what is driving markets? Of course, earlier on I did mention, right, since the last quarter of last year, we have been hearing about the Magnificent Seven, which is referring to the 7 mega cap stocks, companies like Amazon, Alphabet, Apple, Nvidia, Meta, as well as Tesla and Microsoft. These are the 7 major stocks that has been basically taking the market ever higher. When we look into the composition of this rally, you'll find that other than these 7 mega cap stocks, the rest of the index, the component stock of this index, does not really have such a massive rally. So it has been led up by only these 7 stocks. So what I'm trying to say here is the rally is not broad-based. This is not broad enough to actually sustain. So anytime we have profit income coming in for the 7 mega cap stocks, then of course the index is going to reflect that reality. Okay, so here we are right now, especially at the beginning of this year, everything that Nvidia do seems to have turned into gold. Okay, and only recently we can see in a single day Nvidia stocks, has actually rocket. Okay, so and that's because on the back of the better than expected earning reports for Q4. Okay, so Nvidia is telling us that Q1 is going to be even better. So that is actually keeping a lot of market participants very excited about what's going to happen in the AI space, especially in Nvidia as far as they're concerned. So we have market expectation, and has the market price in all the good news. And if in the coming weeks and months, if there is no follow through buying, what will happen to the equity markets? This is the big question, the $1 million question everybody's asking, right? So we will have to see what happens as the weeks turn into months and what happens. And of course, this year is going to be a very, very, very exciting year, because everywhere we can see that it's going to be elections. Okay, we just finished the Indonesian presidential election. We already have a new president, incoming president, which will be taking over from Jokowi. Okay, of course, Indonesia will not be not going to affect how the U.S. equity market trades. But as far as we are concerned, living in this region, we know that it's going to be a change of stewardship, right? So coming in March, what else is happening? In March, we also have a major election that's happening in Russia. There will be a presidential election in Russia in the middle of the month. I think it's coming in on the 15th, if I'm not wrong. And whether the incumbent is going to be able to serve another term, or somebody else is coming in to lead Russia. So that will be crucial. And of course, the big one will be in November, where we have the U.S. presidential election. And from the polls and from the primaries we have seen so far, it shaping up to be going to be Donald Trump versus Biden all over again. Okay, so this could be monumental, because this year that we have seen a lot of division within the American society. So this election year could also be transformational. So there's a lot to unpack here. Okay, so let's look at the economic story. We can only go with data that we can get our hands on. Everything else is speculation, right? So as far as the economic growth story of the United States is concerned, we can see that the U.S. GDP during Q3 has a blockbuster number at 4.9%. 4.9% for a very mature economy like the United States is actually very, very rare. Okay, 4.9 is actually a very good result if we think this number is going to be representative of how healthy the US economy is going to be like. Then in Q4, we don't have a equally good number. It came down to 3.2. In fact, this number has only been revised this week from 3.3% to 3.2% in Q4 of 2023. So we will not know the Q1 number until somewhere in April. This is expected to go below this number. Okay, so we can see that we have a very buoyant US economy. On an annualized basis, you can see that U.S. economy grow at 3.1%, which is very, very respectable for a very mature economy. So going forward, we have 3 quarters. We have, on an annualized basis, a fantastic U.S. economy. So this will be the basis in which whether the Federal Reserve is going to cut interest rate, which is going to be the next big story. Okay, since the beginning of the year, the story has been why equity market continue to go higher, because the Federal Reserve is expected to cut interest rates, basically doing a U-turn on its very aggressive monetary policy for the last 40 years. This is the most aggressive interest rate hikes we have seen. Okay, we may not, some of you may not have actually seen the early days in the 70s and 80s, how the inflation actually was raging. Now we have this example here, but it was actually coming down for the last 1.5 years. We have seen inflation has been coming down. Inflation in the States has actually peaked in June of 2022. Okay, so we have been seeing lower CPI numbers since then, and that is telling us that inflation, at least the headline number seems to be telling us that inflation is becoming manageable, and but it has yet to hit the target rate. The Federal Reserve has a target rate of bringing inflation down to 2%. We are close, but not close enough for the Federal Reserve to actually start to think that maybe they have already won the fight against inflation, and it's time to roll back the very aggressive monetary policy, which is to start cutting interest rates. And stock market has been going up because of this expectation of lower interest rates. Now, the cost of capital is actually interest, right? So if the cost of interest goes down, theory says that it should be cheaper and make doing business a lot easier. Consumer will be able to have more cash in their pocket so that they can actually go out and spend. But there is always a flip side to the same story. Okay, every coin has 2 sides, and later on I'll be showing you a chart on why I think cutting interest rate may not necessarily be a bullish development. Okay, so later on I will come to that. Okay, so we can see US economy is doing very, very well. Not sure what is going to be happening this year, although I have my own view privately. I think the US economy may actually not do so well this year. Okay, over the last few months, we've been hearing narrative about a soft landing. Now, what exactly is a soft landing? Now, if you have ever taken an airplane and the plane is getting ready to descend, okay, eventually soft landing means, you know, the plane will have a very smooth landing when it hit the runway, right? So that will be very, very nice, whereby the landing itself is not bumpy. Okay. Now, the other narrative is, of course, a hard landing. A hard landing is, of course, not very comfortable. Have you ever taken a flight whereby the landing is not smooth, which is actually quite bumpy? You know, I have ever taken a flight whereby the plane practically dropped off from the sky, you know, and we get parked rather than a smooth landing. Then the other narrative is no landing. Now, what is no landing? No landing means the market will continue to grow, and the plane is not landing. Okay, so a landing means the economy will slow down, and you know, if we don't, whether we're going to get a recession. Now, last night we have the Fed chairman testify in front of the House Banking Committee, and he has, in his very plain words, he says no rate cuts for now, but there will be rate cut at some point in 2024, and he's still waiting for further evidence that inflation is substantially down before he actually move on the interest rate front. That is telling us, at least for now, at least for the next FOMC meeting, which is going to be scheduled for March, there will be no rate cut. So forget about buying the story about rate cut and buying equity because of rate cuts. The rate cuts may come somewhere in the middle of the year. Earliest is May, I think most likely will be in June. Okay. Now, what makes the U.S. economy strong? Okay, if you have been studying U.S. Economic data, you will understand that U.S. GDP is make up 70% by consumerism. Okay, now Americans love to spend. Okay, and retail sales is the most visible indicator to show us whether the U.S. economy is doing well, because 70% of the GDP is made up of retail sales. So retail sales is actually very important data. So we can see that retail sales has not been doing very well. At the start of the year, we can see this January came down to negative 0.8%, which is not good. Okay, so when you have numbers like this, it will point. This is like more like a leading indicator. GDP is because you only publish those results 4 times a year. And in order to know Q1 numbers, you will have to wait until somewhere in April before they compile all the data and come out with a composite, right? So now we look at the January retail sales is already bad. So we have already passed February. So some point in this month itself, we will be knowing what is the retail sales number for the month of February. Okay, it will not be a pretty number. Okay, and if we have 3 months consecutive lousy number for retail sales, Q1 GDP will not be as strong as 3.2%. That is almost a given. Okay. Now, when you look at the retail sales number, the substack of this data here, we want to see where, in what areas Americans are spending their money. Okay. We can see that as far as the sector in which they do spend, okay, you can see most of them are actually shrinking. Okay. Meaning to say Americans are not spending very much on this sector here. Yes, they still spend on food and beverages, and they also spend on furniture. Okay. Other than that, everything else is in the negative. Okay. So we can see that Americans are not opening up the wallet to spend, in a way that will actually tell us the GDP is going to be a very strong one in Q1. So this will be the early warning sign. So this is where the thesis is here all about. Retail sales is bad, it will lead to a lower GDP number. Okay, and what about inflation? Inflation is the exact opposite of growth. Okay, so the Federal Reserve have a dual mandate. One is to make sure that the U.S. economy continue to grow at an even keel, and the other one is to make sure the prices are not excessively elevated. So they have to not only control inflation, they also must actually ensure that the economy is humming along well. Okay, and these two objectives, okay, are not incongruence. They are actually opposite of the same coin. Okay, if you have economy doing well, you're going to have inflation. Okay, so if you have inflation running away, it will impact how the economy can grow, because if higher prices means consumer will have to make a hard choice in what corners they would have to cut, just so that they can balance out their expenditure, because everybody has a fixed amount of income coming in every month. So we will have to prioritize where we want to spend. Okay, there are certain expenditure totally cannot be avoided. For example, rent. Okay, so rent and mortgage is something that if you own a property or you rent a property, those are fixed costs you have to pay. Okay, so higher inflation means the Federal Reserve would have to do all it can to tame inflation, and they only have one very crude tool, which is to move interest rate up and down. Inflation high, they will move interest rate high to make the cost of consumption high. So in the hope that consumer will be rational, and they will prioritize their spending and do not overspend, so that over time should bring inflation down. Okay, so we can see interest rate has been very elevated, since the first quarter of 2022, and that is no accident. When you notice later on how the inflation has actually been raging months before the Federal Reserve actually start to hike interest rate, you'll find that the timing of the interest rate hike, or at least the first interest rate hike, is actually timed 2-3 weeks after the war in Ukraine started. So everything do not happen in a vacuum. They are all interrelated. Okay, so my skeptical mind, my cynical mind will go into overdrive and try to piece out why things are happening the way it do. Okay, because those are very important in your overall outlook of the markets. Regardless of what you're trading, whether you're trading equities or whether you're trading some other stuff, knowing the directional move of inflation, interest rate is very, very important, because at the end of the day, like I said, interest rate is the cost of capital. Okay, so we understand if the cost of capital is it going to stay high or is it going to come down? Basically, in reflection of the economic reality, right? So we can see inflation here. There are two lines here. We have this PCE and the CPI. We all know what is CPI, which is Consumer Price Index, and that is represented by the orange line. Okay, and like I said earlier on, it peaked somewhere in in June. Okay, at 9.1%. Okay, this is the core. So you don't see the real high. The high is actually 9.1% in the headline numbers. And then the PCE is actually the personal consumption expenditure. This is another set of inflation data which is favored by the Federal Reserve. They pay more weightage to the PCE number, and we can see that both lines are more or less moving in the same direction. It peaks in June and it has been coming down. So the trajectory suggests that inflation is coming down in the States, but it has yet to hit its target. You can see the CPI number is still at 3%, okay, above 3%, where the PC number is close to the target rate of 2%. 2%. So the stated target inflation rate is 2%. So until these rates can stay consistently at 2% or near 2%, then the Federal Reserve will have the leeway to start to cut interest rates. The Federal Reserve make it very, very clear that he needs to see inflation moving closer to 2% before he actually acts. Okay, so we can see since January, January is when the Federal Reserve came out during the FOMC meeting, which is the Federal Open Market Committee, and he states very clearly that they are done with rate hikes, at least for now. Okay, unless inflation flares up again. And we are beginning to see that. You can see that in the month of November to December, inflation actually perks up. Okay, although in January it dipped back again. But you can see that the fact that the market has not continued to go down, especially the orange line, okay, is a bit of a troublesome. They call it sticky inflation because they need this trajectory to go down in this manner very sharply towards 2%. But what we have over the last, from June to March this year, over the last 9 months, okay, we have seen inflation has not continued to go lower. It has gone sideways, and with the risk that it may actually bump up. Okay, so this is the risk going forward. So unemployment, the other one to look at the health of the economy, other than looking at the GDP growth, is to look at the state of the labor market. So tomorrow we're going to have non-farm payroll, so that will be another number to watch out because we want to see not only the unemployment rate, we want to see how many jobs are being created. Okay, so when you look at the non-farm payroll, you've got to be very, very clear that non-farm payroll is not exactly the best number to look at the health of the labor market, because when somebody is not actively looking for a job, they will drop off from the statistics. Okay, and if a person holds more than one job, okay, if I'm an Uber driver as well as I am a Uber food delivery guy, I hold 2 jobs, that will show up as 2 jobs, but it's only one person. Okay, so you've got to be very clear what you are looking at. So the number of job creation, okay, is not necessarily telling the full story. That also includes the unemployment rate. Because unemployment rate is just a ballpark number. Okay, what we can see in this number here is that unemployment rate has been actually very unstable. It has been more or less been rising. Okay, and that is not a good sign, because if unemployment rises, it means the economy is not doing that great. Okay, and we can see unemployment rate has been on the up and up only until towards the end of the 2023 that we have seen prices, this index come down to 3.7. Okay, so what is going to be expected for tomorrow? 3.7. So if this number come in worse than expected, meaning to say the number goes up, or the number comes in better than expected, means the number go down, it will impact equity markets. It will also impact currency rates. It will impact the treasury yield, for example. So everything is dependent on tomorrow's number, as because those are big numbers. So when we look at this unemployment rate, does it paint a picture that U.S. economy is doing well? We have rising unemployment. Okay, it's only recent months we can see the market dips, but it has not continued to go down. If this number goes down, okay, that means to say the labor market is very healthy. Then the Federal Reserve will have the ability to cut rates. If unemployment starts to go up, okay, which is actually what they want to see, honestly, because if the logic goes like this, if somebody is unemployed, they are living on their savings. And when you are living on your reserve, mean to say that you have to be even more careful on how you spend, when you spend, and what you spend on. So basically, lower unemployment rate means the U.S. labor market is healthy, and this is actually bad for the inflation story. Okay, so in order to actually gel in with the CPI numbers, this number needs to actually go up to show that unemployment has actually taken hold, and Americans are not in the position to spend like they used to, and that is actually going to be good for the inflation story. So always look at both sides of the same coin. Yeah. Now, all this talk about interest rate cuts. No, last year we talked about this, and they have a new term for it. They call it the pivot. No, we all knew that the market, the Federal Reserve had high interest rate all the way to 5.5%, and it has stuck at that level for months now. Okay, and in order to cut interest rate, they call it a pivot. A pivot is meaning doing an about turn, right? So they call it a pivot. But this year, the word has not come in. Okay, they have been talking about just plain interest rate cuts. So this interest rate cuts, what does it mean? Is it necessarily a good thing? The markets is believing any kind of interest rate cut, okay, is going to be good for the economy, okay, because interest rate stays elevated, it means everything costs more. The cost of capital costs more, meaning to say businesses will find it very punitive to actually borrow, to actually expand their factory line, to actually expand their business, and that will not be conducive for the business environment. And on the consumer end, if you have interest rate that are high, we all know Americans do spend tomorrow's money. Okay, basically, the idea of using credit card actually started in the 70s from America, right? So I remember when I first had my first credit card, it was a charge card. It was not even a credit card. It was a charge card, American Express, and those need to be settled at the end of when the bill comes. You have to settle in full. Okay, so credit card is very different. America has the habit of spending tomorrow's money first. Okay, so we can see that if we have elevated interest rates, the interest rate on credit card is also going to be elevated. Okay, over here in Singapore, we pay fixed rate 2% a month. So ballpark number, you pay 24% a year. But in America, this rate is not necessarily pegged to a fixed rate. It is a floating rate. Okay, so if interest rates are elevated, obviously the cost of servicing all your various loans, whether it's mortgage loans, car loans, they're all going to be expensive. Imagine U.S. mortgage rate right now is 8%. Now 8% is very far away from what it used to be at 3%. So we can see that the cost of financing a property has actually become so much more unaffordable. And this is also laying the groundwork for the banking crisis that we saw much of last year. And of late, we can see that there's one bank in America that is again teetering on collapse. And the irony is that this bank actually was one of the savior banks that actually bought into those banks that actually failed last year. Okay, so again, high interest rate is going to have catastrophic and negative impact on the economy. So any kind of rate cuts is actually going to be welcome. Okay, but later on, let me show you why I think when you get what you wish for, you may not be too happy about it. Okay, now this is the chart. Okay, I call up this data from the Reserve Banks, where the branch of the Federal Reserve at St. Louis. There's a ton of data on the website, and this is just one of the website, one of the data that I pull up. I just want to show you. You can see that this is the line. The blue color line is actually where interest rates goes up and where interest rates comes down. You will notice that there are shaded area here. Notice every time the interest rates goes down, starting in 1957, okay, again in 1961, again in 1970, followed by 1974 to 1975. Then every time we can see interest rate cuts where the interest rate goes down. This shaded area represents period of recession. So whenever you get an interest rate cut, it's almost always followed by a recession. And it makes sense because if I'm a central banker, the only time I will cut interest rate is because I want to stimulate the economy. And why would I want to stimulate the economy if the economy is doing well? Right now, the US economy is, based on the GDP numbers that we have seen from Q3, Q4 last year, is telling us the US economy is doing very well. So if everybody is asking, calling for an interest rate cut. As a central banker, I would not want to cut interest rate to make it cheaper for people to actually spend, because I have almost won the fight against inflation. Cutting interest rates means I will allow inflation to flare up again. That will totally defeat what the Federal Reserve has been doing over the last 2 years. Okay, so definitely, despite the interest of the Federal Reserve to cut rates in a booming economy, the only time they will cut interest rate is when the economy is slipping. Okay, and slipping means it is decelerating. So be very careful what you wish for. Interest rate cuts always followed by a recession. It has not failed as far since the day I'm in this business. Okay, over the last 80 years, every interest rate cut is followed almost immediately by a recession. The shortest one is actually 2 months. Okay, the duration of the U.S. inflation ranges from 2 months, which is this is a outliner. Okay, we shouldn't take this. Minimum 6 months to 18 months. Okay, so if we are very optimistic, market can rebound very shortly after the recession. The last time it happened was back in 1980. Okay, and that recession last 6 months. The longest one was during the global financial crisis. It lasts 18 months. Okay, so we take a medium, somewhere about maybe 12 months is about right. Okay, for an average US recession to last. The reason why we have 2 months here in 2020 because it's the pandemic triggered recession. Okay, of course the US Federal Reserve flooded the market with a lot of liquidity and pulled us out of this recession. Okay, so that one only lasted 2 months. So this one is exception to the rule. But basically, if we have a recession, it is definitely somewhere in the ballpark of maybe 10 to 12 months. Okay, extreme is of course 18 months. So right now this is where we are right now. Interest rate has gone up so much. Any kind of interest rate cut, meaning interest rate comes down, is going to follow swiftly by a recession. So are we going to be looking at the situation in which the US economy will go into a recession? Now this year is going to be very unique. This year is a presidential election year. And that means typically the Federal Reserve will not want to do anything to hurt the incumbent. Okay, so there's a good chance they will do 1 or 2 cuts for sure. Okay, and the market may buy that as a sign that it's time to go back into equity markets. But I think that is a very dangerous assumption. And the timing of the presidential election is in November of this year. That means when the new president, or not, let's say Biden gets re-elected, okay, he will be sworn in January of 2025. 2025 is going to be the key period in which I think a full-blown inflation, a recession will come in. Okay, so for now they will be still in a market whereby the market will be still in the flux. Okay, it could go up, it could come down, but I think we are very near to a temporary top. Okay, and how do I come to the conclusion? We look at the technical itself. Okay, because right now the market is euphoric. Okay, and I think Alan Greenspan used this word called exuberance. Okay, market exuberance, because market was like, there was no reasoning behind the buying. Everybody is FOMO. FOMO stands for fear of missing out. Everybody is just buying, just hope that market will continue to go higher. But that is very dangerous because it's only supported by 7 mega cap stock. Okay, so just be aware of that. Now, the other thing that we have to be also conscious about is the state of the U.S. finances. Okay, U.S. national debt, last I checked yesterday, was $34.4 trillion. And this chart was only updated, 3 weeks ago. I only updated this chart this afternoon. But 3 weeks ago, when I did the draft presentation of this slide here, the number here was 34,330. So it means that U.S. national debt is accumulating at a rate of maybe 100 billion every 3 weeks. And this is very scary because now when we look at this number is actually, we are all numb to this number because what is in a trillion? A trillion means it has 12 zeros. Okay? Now to give you a perspective of how long it takes the United States to accumulate $1 trillion in debt, it took them on average previously 12 years to get to $1 trillion in debt. But now it appears that US is accumulating so much debt at a rate that we have never seen before. Every 3 months, the US national debt increased by $1 trillion. It means by the middle of this year, this number will go to 35 trillion. And the burden of servicing this mountain of debt means the US will be spending a lot of money just to service this debt. We're not even talking about paying off the principal, okay? And this year we're going to have a lot of bonds that are due for repayment. Okay, so on top of the interest they have to pay on this mountain of debts, they will have to find ways and means to raise a few $trillion just to pay off the principal. Okay, so we are definitely looking at the debt crisis here, because this is totally unsustainable. We have the Fed chairman coming in and said this is totally unsustainable. The way the federal government is spending money, okay, is totally unsustainable. It means at some point this will be a big issue. Okay, and of course the way the US borrows money is to issue more and more treasury bonds. And used to be foreign buyers buys those debts. Okay, but there has been quite a few years now we have seen a major buyer has been staying away from the US bond market. They are not buying as much. Some are actually unloading. Okay, and between the foreign buyers and the Federal Reserve, between the two of them, okay, the Federal Reserve actually pick up the slack. Okay, accounting for about 25% of all all treasury bonds being issued. The Federal Reserve will create the credit to buy these bonds, which is left hand passing on to the right hand, basically. Okay, so but what we also knew is that the Federal Reserve has not been buying the whole of 2023 because they are doing what we call quantitative tightening. Quantitative tightening is the exact opposite of quantitative easing. Now, if you have heard of QE, QT is the exact opposite. QE means they are going to flood the economy with a lot of liquidity. They're going to create so much credit, and they are going to flood the economy. But last year, 2023, we have seen the Federal Reserve has been cutting back, and that's actually more or less impacted the liquidity in the marketplace, which is something that we also have to consider. See, the world go around because of credit. If credit becomes hard to come by, it will restrict growth. Okay, so we are seeing that right now. The Federal Reserve is no longer buying the Treasury, and between the foreign buyers not buying, and some of them are actually dumping U.S. Treasury. Traditional big buyers are China. China now from the #1 buyer of U.S. Treasury has dropped to #2, and the amount that they have actually unloaded is more than 40% for its peak. So it does look like the Chinese are definitely going to de-dollarize. They do not want to hold those debts in dollars. Okay, so that's a mega trend, not helped by the fact that during the start of the war in Ukraine, the U.S. has actually weaponized the dollar itself by seizing Russia's $300 billion worth of reserve, which is accounting for half of Russia's foreign reserve. But the bulk here is not frozen by the United States. The bulk is actually held in Europe. Okay, so Europe holds the bulk of the frozen Russian fund, and now they are talking about using the proceeds from those funds to pay for weapons for Ukraine. So obviously, this is not acceptable to Russia, and this could lead to a further rise in tension in Europe itself. Okay, we'll come to that. That will be another factor to consider. Now, will we get a recession? Now, this month is 2 weeks ago we get news that Japan and UK are in recession. So there's this company, there's this group people call it G7, the group of seven. They are the rich man club. Okay, all the wealthiest nation inside the G7. It consists of countries like United States, UK, Germany, Japan, Canada, France, Italy. Okay, exclude China. China is not inside the G7 here. So of the 7 major economies, 3 of them are already in recession. Germany is definitely in recession. Okay, although they don't call it a recession, but the data has been telling us it's definitely in recession. In fact, the whole of the Eurozone is at the borderline case. Okay, they managed to escape the classification of a recession Eurozone wide. Okay, because they have a marginal growth in Q4. Okay, and that basically means that by pure definition, they are not in recession. But you can see for oil and net purposes, they are not growing. Okay, so Europe as a trading bloc it's already in recession. Japan is definitely in recession. So when we look at the G7, almost half of them are in recession. The only few they are not in recession, France, Italy, they are borderline case. France has stopped growing. No, Italy has stopped growing. France has actually managed to actually register marginal growth. But overall, okay, there's a danger Italy and France will join Germany in recession very, very soon over the next few quarters, okay? And that means the only one within the G7 holding up their economy is the United States. Principally, we have Canada reporting 1% growth. Okay, Canada was the last to report their Q4 numbers, and it came in last week at 1%. So it came in this week at 1%. So 1% means that okay, it has some kind of decent growth. But the best one is of course the United States, based on this blue color bar here. You can see, right? So U.S. now holds, okay, the only nation that has not majorly slipped into recession. So everything now depends on the United States economy. If the U.S. economy slips, okay, that means we are looking at not just a recession in the States, we are looking at the risk of a global recession. Now, global recessions are very, very rare. The last time we have a global recession is back in the global financial crisis in 2008, 2009. That was the last global recession. It means that we have synchronized every major economy slips into recession. Now, in those days, China was not in recession. China was able to spend its way out and drag the entire world along. Okay, so China was the ballast that actually propelled up the global economy when the rest are all doing poorly economically speaking. Okay, but this time you can see that China is not in that position to actually lift, okay, the global economy out of the hole. Should we go into a global recession? Because China is also struggling right now. Yes, you can see GDP numbers for China is at 4.9% in Q3, 5.2% in Q4. So on balance, this number looks respectable. But if you have looked at China GDP growth over the last 30 years, it averaged about 6.5%. Okay, it's not as good as 6.5% right now, it's sub 5%. But it's a big deal for China because the China economy is so big, okay? So right now, definitely Chinese are battling a property bust. We are also seeing the impact of the lockdown during the COVID, which is China is just suffering from that. On top of that, we have this trade war and economic war, currency war, technology war that the US has launched against China. So everything else is pointing to a global recession going forward. So we have to make sure we make preparation for that. Okay. Now, on top of that, the other thing we have to consider is the risk of geopolitical tension. Okay. All these shaded area here are areas in which there is an ongoing war or risk of a war. Okay. Of course, we have one that currently in Ukraine, and this one has been in the third year running. Okay. When they launched this war, when this war happened back in February 22nd of 2022, they thought that this war will end very, very soon. Okay, but 3 years after that war started, we are still in the midst of fighting, and this war here has the risk of actually expanding because Sweden just joined NATO. Okay, and this is Finland actually. Okay, but Finland have the longest common border with Russia, other than Ukraine. Okay, so now they are actually conducting a very massive military exercise in the Baltic, and this is making Russia very uncomfortable. Okay, so this thing could actually evolve into something totally ugly because this operation, okay, this military exercise will last all the way to May. And why May? May is when whoever wins the Russian presidential election this month is going to be inaugurated, and the date is May the 7th. So keep this date in your calendar because that military operation exercise lasts until then. Okay, it could actually turn out to be not just simply a military exercise. Okay, here of course right now we have this situation in the Red Sea. This is the Red Sea, right? We have this problem in the Gaza right now. This is Israel. Okay, so this war here has actually is very inconvenient because US is supporting this war in Ukraine right now. Now they have to also support another war ongoing in the Gaza Strip. Okay, and this war seems to be expanding because when Israel launched their military sweep along the entire length and breadth of the Gaza Strip itself, Hezbollah, which is in Lebanon, has also started to attack the northern border of Israel. So this war has actually expanded. And what the other neighboring Mediterranean nation do is going to make or break this war here. Because I think now the US is financing two wars at the same time. They are also physically involved in this fight here because they are trying to patrol the Red Sea here. We all knew that in Yemen, this is Yemen here, they control a choke point here, okay? And the Houthis militants actually has been trying to restrict cargoes, vessels, and as well as oil tankers from transiting this Red Sea. Because Red Sea is the nearest, okay? There is a Suez Canal here, okay? And in order for goods and services and goods to move from the oil producing area to Asia, to Europe, they uses this Red Sea as a conduit, okay? And now all this cargo will have to, before they can go to Europe, previously was very simple, right? They transit through the Red Sea, through the Suez Canal, and the goods can arrive in Europe, okay, very effectively. Now they have to make a roundabout way, go down to the Cape of Good Hope, and then swing by the entire length of Africa to get to Europe. And this, of course, will make the logistic more unaffordable. And not only that, insurance costs will go up. So everything else points to elevated prices. So the European will be bearing the full brunt of this. And to a certain extent, Asia will also bear the fallout from this fight that's ongoing in this Red Sea here. Now, the other hotspot will be Asia. East Asia has always been a hotspot, okay? And of course, we have this little island here called Taiwan, and this is definitely something we will have to watch very closely, okay? Now, the other one in South America, Guyana. Okay, Guyana is a country that's very, very small, okay? Venezuela threatened to invade Guyana because Guyana, they found massive reserve of oil and gas. And Venezuela said, this place used to belong to me, I want it back. And there's a risk that Venezuela, if they actually take military options to move into Guyana, to actually seize the land here, up north here we have Brazil. Brazil is definitely going to fight them. So this is going to be another hotspot happening in the backyard of America. So all these are potential hotspots here. We have to watch this geopolitical. This will directly lead to the price of gold. We also notice that this week on Tuesday, spot gold has actually broke into all-time high. And as we are speaking, I believe it is already trading into new high. Okay, so this will have an impact. Now, gold prices, later I'll come to it, why I think gold prices is going to be very bullish going forward. Last month, I did one presentation for a broker here, and I told them in that presentation that February is the only time you can buy affordable gold. After February, prices of gold is going to be out of reach for most of us. Okay, that means to say I am very, very bullish on gold. Okay, so this is the exercise called the Exercise Steadfast Defender 24, and this is the military exercise by NATO involving 90,000 troops. Okay, so you have a lot of troops for an exercise that lasts for months. Now, normally military exercise do not last for months. Okay, and the fact that it actually coincides to end in May of this year, incidentally, that is also where the new Russian president will be sworn in. Okay, so something is cooking up there. We have to be very aware of what's really happening. Okay. Now, equity markets. When we talk about U.S. equity markets, we talk about the major index. The major index, we have the Dow Jones, we have the Nasdaq, we have the S&P 500, and one lesser known index is called the Russell 2000. Okay, so we start off with the S&P 500. This is the trajectory. The market is in a major bull market. So as of Monday, this market is actually at an all-time high. And since then, the market has been coming down a little bit, okay? And I think it will continue to come down a little bit more, okay? So we can see that year to date, the S&P 500 is already up 7%. Okay, and this is not uniform in the sense that the Dow Jones do not have such a great growth yet. Okay, so over the last 1 week or so, it's up less than 1%. Over the month, it's up 2%, but over the year to date, okay, it's up 7%. So you can see the trajectory is actually very bullish. Okay, and this is the Nasdaq 100, which is a sub-index for the Nasdaq Composite Index. Now, if you are into tech stocks, you have to know this index because everything in the tech stock is listed in this index here. Of course, we also have cross-listing of the 7 mega cap stocks listed in the Nasdaq, also listed in the S&P 500. So when we look at the index itself, S&P 500 is a broad-based index. It is, I would consider it as a retail index because most retail investors will be buying and selling component stocks of the S&P 500. Okay, so the Nasdaq is predominantly tech stocks. So both markets seems to be moving in sync. Okay, so we can see that the Nasdaq goes up into fresh all-time high as of Monday. Okay, we can see that this is still a market that is still very, very bullish. We have a bit of a pullback here. That was during the pandemic, and the market has been going up since. Okay, so this is how we can see. And the Dow Jones is a bellwether index. What do I mean? If you are a global fund manager, this will be the index you want to be watch that you want to watch because every of their performance has to be indexed against these major Dow Jones. Whether they outperform, whether they underperform, is always based on their performance relative to the Dow Jones. So retail investors do not trade this index. It is the big money index, okay? And it is only up 2.6%. Now, the S&P 500 up more than 7%, right? So we can see that the growth in the Dow Jones is not uniform as those in the S&P 500 and the Nasdaq 100. Just to give an example, the all-time high in the Dow Jones was actually traded 2 Fridays ago. Over the last 2 weeks, this index has not registered all-time high, whereas the S&P 500 and the Nasdaq registered all-time high as late as Monday this week. So we can see that this index is not necessarily following the tech stocks higher. Okay, so here we have to watch out for, if there's going to be a weakness, it's going to be this index. Okay, so do watch out for this index for telltale signs of a impending top. Okay, a top means a temporary high. Okay, I'm not calling for the collapse. I'm thinking that there's the market needs to pull back to be healthy. Okay, so this could be something you want to watch. Now, the other thing you have to watch is that earlier on we talked about geopolitical tension. Now, war by definition are inflationary. If the situation in Europe evolves into something beyond just fighting between Russia and Ukraine within the border of Ukraine, that war is contained. However, now we are beginning to see signs that the other NATO countries wants to get physically involved in the fight. And Russia has already said if they send regular troops into Ukraine to fight the Russian, it will be an all-out war between Russia and NATO. And in the case of this, you can expect Russia to take out the bazooka. They are not going to be, they're not going to play nice anymore. And if that happens, there will be capital flight out of Europe. When we look at World War I, World War II, you notice that whenever there's a big war, European war, all-out war, capital will flee. Okay, in fact, any kind of war in any region, whenever there's a war in that region, capital in that region will flee to find a safe haven. And where is the safe haven for the European? The US has never been. The US mainland has never been in a war. So that US is considered to be the safe haven. So if the war in Europe actually escalate, okay, you can bet your last dollar European money will fly to the United States. And once the money reaches the States, it's not going to sit idly in the bank account. It will definitely deploy it into the stock market. So look out for the Dow Jones. If you see Dow Jones stay elevated in a war that's raging in Europe, that is the capital flight, okay? And that will sustain the rally in the Dow Jones. It may not necessarily be in the other equity index, but Dow Jones will be the one index you want to watch, okay? Because of this global capital flight, okay? So how are we going to use all these things that I just mentioned and tie it into something that you can actually make money. Okay, if you got a view of where the market is going based on the various factors, whether it's economic consideration or whether it's geopolitics, the market will actually price in all this, and it will move in one direction. So if you are aware of what's really happening and you have a view, then you can use futures contract to actually participate in this. There is this notion here, okay? We are not trying to make money from a crisis. This thing is going to happen with or without us, okay? So rather than be the victim, I choose to actively try to see if I can make money out of something that I have no control over. It's going to happen regardless, right, of what I do, okay? So I choose not to be a victim. I find that if I have missed out the bull market, the market has been running higher and higher since the end of the pandemic itself. And if we have missed out the biggest bull market we have ever seen, fear not, because the biggest money you can ever make is in a falling market. I have personally witnessed how fast you can make money in a bear market. Now imagine from 2020, the bull market ended, the pandemic ended, okay? And the new bull market started from March of 2022. You can see that the price, the index itself has all gone almost vertical, okay? So over the last 3 to 4 years, if you have missed out on this biggest bull run, I can bet you my last dollar, when the bear market comes, you do not have to spend 3 to 4 years to make the same amount of money, okay, in a bull market, because in the bear market, time is compressed, okay? Back in 1987, when I was very, very young and very, very new, okay, I was a greenhorn. I entered this industry back in 1985, not knowing anything about what is futures. And obviously, I have not made money in stock market because I never traded stock, right? But I was fortunate enough to actually participate in the Hang Seng Index. And I witnessed a vertical fall, okay? That fall is so scary. In percentage terms, it is the worst stock market crash the world has ever seen. So now there are talks again that we are likely to see a very similar situation when the next stock market crash comes. Okay, it will be in terms of magnitude, in terms of percentage term, it could be as bad, if not worse, than back in 1987. So that gives you some idea how severe a stock market crash can be, and it can be happening. It can be all over in a couple of months. Okay, it takes the market 3 to 4 years to run up to where it is right now, but it will take the market just 1 month. Okay, for it to erase everything that we have seen so far. So this is the beauty of futures market based on equity index. Okay. Now, futures has been around for millennia. Okay. Some form of futures trading has actually occurred during the Meiji period. You know, in those days we still have Japan only slowly opening up to the outside world, and they are basically commodity-based economy. They trade rice. Rice is the major commodity they trade. Okay, how does it work? For example, if I'm a rice farmer, I will not go into production unless I know for sure that I will make money out of my labor. Okay, and how do you know you'll make money? Okay, now whatever the farmer grow, the merchant will come and buy his harvest, because the merchant is like a middleman, right? He buys from the farmer. Okay, so if the merchant here do his homework, he can more or less tell based on the season of the year, okay, what is the price of commodities based on previous period. So he may come to the farmer and say, look, I will buy all your harvest, whatever you're planting, and this is the price, okay? And the farmer look at the price and say, okay, this price ensure that I will make a profit. So the farmer will go into an agreement with the merchant, okay, to secure. For the farmer, he secure a profit. For the merchant, he secure supply. Okay, so what happens is that both parties are happy with the deals. This is the earliest form of a futures contract. Now, in the futures contract, you can see that we don't trade full value. The power of margin is exemplified by futures trading. This is what I call leverage, right? You put in a fraction of the total contract size, and you maybe put in $1,000, but you control the nominal size of the full value. And so this is actually can cut both ways. It means that you can actually use this as a leverage to actually expand on your profit potential. So the power of margin is very, very high. and this is something very peculiar to futures contracts. Now the cost of trading. There are only two. Okay, one is the spread between the buy and sell price. The other one, of course, is the commission charge. I remember when I started off trading futures, commission was way, way, way high. It will not be surprised that it will not be uncompetitive to charge a client $70 per round turn. Okay, these days, do you pay anywhere near $10? I don't think you do, right? So cost of trading has actually gone way down. Okay, and that has been helped by the advent of online trading, because everything go online. Customers now place their own order. They don't have to go through a broker. Okay, broker don't have to execute the orders for you. Just give you the platform, you execute yourself. So the cost actually went down. So it's actually quite advantageous, because this, unlike equity trading, you pay a percentage of the value of the stock that you buy or sell. So in terms of cost, I think it's a lot cheaper, more competitive in futures contract, and the market is super liquid. Okay, and where the center of gravity is in Chicago, it's in New York itself, and this is where most of the US exchanges are based. Okay, and the liquidity is very, very deep. One of the ways to mitigate your the overall risk, the mission you trade a product that has very deep liquidity. Means to say you don't have to give up the advantage of the spread. Every time you want to buy, somebody will be selling to you. That keeps the market very competitively priced. Okay. Now, of course, hedging is another thing. Now, if you imagine if you are a typical stock investors, and you have been buying, and then you're sitting on a nice profit, but you look at the overall market, it does look a bit toppish, and you have two options: either to sell whatever you have in your portfolio in stocks, or you can use futures to actually hedge against your exposure in the cash market. Okay, so without having to liquidate your position in the stock portfolio, you can actually use futures to actually mitigate the risk of a drop in stock prices. So this is a hedging instrument which is very, very useful, and because of that, you can also use it to basically do a naked short. Okay, naked short means you have nothing in hand, but you have a view the market is going to come down. You can actually sell forward, and if your view is correct, you can buy back at a cheaper price at some point in the future. Okay, so this is not looked on very favorably in equity markets. There are many exchanges that try to restrict or outright ban the practice of selling stocks that you don't own. Okay, in Singapore, you can actually do what we call contra. But contra means you can only have maybe 5 working days. Okay, in order to before you need to buy back. So there is a lot of restriction. In futures trading, you don't have all these problems. It's actually one of the few highlights that I can find for trading futures contracts. Okay. So let's talk about the main thing, the equity index futures. The 4 main ones we want to talk about will be the Dow, okay, which you all know is the bellwether index. The S&P 500 is a broad-based index. The Nasdaq is the tech stocks, and the Russell 2000 caters to the small cap index. Now, there are 2,000 stocks listed in this index here, and these are typically small company that you probably have not heard of. Okay, but they do play a role. Okay, so these are the 4 major equity index that the CME has actually offered a new product called the Micro E-mini Equity Index Futures. Okay, now from the big index to the next level, because prices has gone higher, equity market has gone higher, based on margin, it is no longer affordable to the retail investors. So CME came out with E-mini. Now prices has gone way, way higher. Even the E-mini, based on the margin required to buy and sell one lot, is no longer affordable to the retail investors. So they came out with a Micro E-mini, and they launched this very, very conveniently just before, months before the pandemic hit and the volume took off. Okay, this is a very successful offering. In fact, the whole all exchanges that offer equity index futures see very, very good growth, and of course, the best ones are always in the States. Okay, we have the Dow Jones. Previously, the only index you can trade is actually the S&P 500. Okay, and there's no other offering. This comes years later. Okay, so these are the 4 index you can actually trade. So these are the contract spec of the 4 that I just mentioned, and they are denoted by their symbol. Okay, the ES is actually the S&P 500. Okay, the E-mini. Now this with an M in front is called a Micro E-mini. MES is the code for the Micro E-mini S&P 500. You can find that the size is 1/10 the size of the E-mini. $5 times the index give you the whole notional value, and of which the minimum price movement is a quarter point, equals to $1.25. And time of trading right now, you may want to know that after Sunday, the opening hours will move 1 hour backwards. So right now, U.S. market open at 9 o'clock. By next Monday onwards, the market will open at 8 o'clock. Okay, for the actual stock trading. So you can see that this is what I call daylight saving. It will last for 6 months. Every 6 months, they will revert back to regular timing. Okay, this is to save on electricity supposedly. Okay, so the contract available for trading. Okay, you can see that they are all every quarter there's one contract actively being traded. Right now, the March contract is the active one, and next rollover will be June contract. So you notice that this market here is almost 24/5. Okay, it's not exactly 24/5 because there is a 1 hour break in between. Okay, but you can see that after the regular trading hours, okay, the market will switch on the electronic trading platform, which is the Globex, for example. So you can still access the market. And access is very important. You do not want to trade a market whereby something else is moving and you have no access. Even though you can see it happening, but you cannot access the product. That means to say that you cannot take advantage of the price movements here. Now the index are designed in such a way that at the end of the trading for the contract, when it expires, you will be settled financially. If you have a long position that makes money, okay, you'll be credited with the gain. And if you're holding to a losing position by the end of trading, then you'll be debited through your account. Okay, so the margin is actually very affordable. Now, these margins are not cast in stone. Whenever we have elevated volatility, this margin will naturally go up. Okay, so for now, last I checked, okay, is $1,180 for holding a position overnight. This is the maintenance margin. Now, if you are doing intraday, okay, it's even cheaper. $25 to buy and sell one micro E-mini lots. Okay, so you can see that this is the S&P 500. Everything else remains the same except for the value point. Okay, this is the Nasdaq 100. The micro E-mini Nasdaq 100 is $2 times the overall index, and we also move by a quarter point. But instead of $1.25, it's 50 cents. Okay, and the margin required is the most right now. Okay, it's 1,770. It's not one. So it's 1,770. Okay, and intraday is $50. It is still very affordable. Now this is the micro E-mini Dow Jones. This one is 50 cents times the index, and they move by minimum 1 point equal to 50 cents. And the margin is very, very competitively priced. $840 for overnight trade and $35 for intraday trade. Now this one will be less traded because it is not as popular as the other three, but this is something that you want to watch. Right now, okay, we could be seeing a resurgence or maybe what I call the banking crisis 2.0. Okay, we have the New York Community Bank Corp, okay, that will most likely collapse. Although they just got emergency funding of $1 billion, but it looks really, really nervy. Okay, because if it goes down, it could drag a few others with them. Okay, so this one is the symbol is M2K, referring to the the Russell 2000 index. $5 content index, one minimum point movement is 0.1 equal to 50 cents. The margin required is the lowest, and it also goes without saying this one has the lowest traded volume. Okay, but it's something that you want to watch because the banking crisis would impact this particular index more because most of the regional banks are listed inside these component stocks here that make up this index. Okay, so if you have a banking crisis that evolved, this is one index you want to be trading. Now, why is it advantageous? When I look at the volume open interest, it is just a snapshot of how much liquidity there is in this particular market. We start off with the micro E-mini S&P 500. Now, this is the volume. You can see the volume so far as of yesterday is 1 million lots traded. So it means the market is very, very liquid. And we have rising open interest. And what does it mean? Rising open interest means people are holding on to position. Okay, people are not getting out. When you have lower open interest, now the open interest is about 1/4 of the traded volume. You can see that this is the open interest as of yesterday, 250,000 lots, 1/4 of a million compared to 1 million contract traded. That means for every 4 lots, there's 1 lot that's left open. People are holding on to position. Now this one is even better. The Nasdaq 100 Composite Index, the average trading volume in excess of 1.6 million contracts. Okay, so it's almost 60% more than the volume trading in the S&P 500. And this is understandable because all the talks about AI and tech stocks has led people to trade more than Nasdaq 100. Okay, and in terms of open interest, not as much. Okay, only 200,000 are left open. So on a percentage term, this one is 1:4. This one is possibly, we are talking about 1:8. Okay, open interest. It shows that we have rising open interest. People are holding on to their position. They want to keep the position overnight. Whether the position is long or short, it does not matter because one long, one short make up one open interest. So the other one, the Dow Jones, is not as actively traded because I told you this index is a bellwether index, mostly watched by the fund managers. In terms of volume traded, is about 110. Okay, we have about 100,000 lots traded compared to the S&P 500, the micro E-mini S&P. This one is 110 the traded volume. Okay, open interest is about 20,000. Okay, it's not great, but it is still very respectable. Okay, and of course we have the Russell 2000. In terms of volume traded, you can see that the volume traded is less than even. Is it more? I think it's more than currently more than the Dow Jones. The volume traded. Okay, the volume traded is about 20,000. Okay, about the same as it's about. This one is almost 100,000. This one maybe 1/5 of the volume traded in the Dow. Okay, which in turn is 110 the size volume traded in the S&P 500. In terms of the open interest, is also respectable. Okay, it's not as great, but it's respectable. Open interest has taken a dip of late. Okay, so that could be telling people are getting out of the markets. Okay, so you can see both 4 equity index are heavily traded, led number 1 by Nasdaq 100, followed by the S&P 500, followed by the Dow Jones, and then the Russell 2000. Okay, now this 2 weeks ago, the CME have launched 2 more micro E-mini equity index. I did not list them in here. Okay, they are mainly the S&P 500, correct, the big cap as well as the small cap. Okay, so we have the broad market, we have the tech stocks, we have the group bellwether, and then of course we have to cover the base, also track the small cap. So the new index, wait for the volume to pick up. Okay, I'm not recommending you to trade that just yet because the volume has not built up yet. Okay, maybe some point in the near future we can talk about those 2 index, the mid cap as well as the small cap. What about gold? Okay, gold is going to be, it has been in the headline this week. Okay, gold just broke out of a all-time high. Okay, on Tuesday we can see gold prices actually traded to an all-time high. I think as of now there is a possibility we see a follow-through buying in gold prices. Now, what is driving gold prices? Okay, a lot of people say that inflation, gold is a good hedge against inflation. Is this necessarily the case? Let's take a look at the chart. Okay, now this is the price of gold. Okay, April gold traded this afternoon was $2,156.40 per ounce. Okay, and yeah, it's come down marginally. Okay, so on the based on yesterday's closing price, it's down marginally. But overall, we can see that the market is at an all-time high. Will these prices continue to go higher? So that will be the question everybody want to ask. In my opinion, I would say yes. Okay, where it will go, I'm not going to speculate, but I have a solid number in my mind. But it is my view. Okay, so it's not going to be something that unless you ask me, I'm not going to tell you. Okay, where I think the gold price is going to go to. But I think it's going to be a lot more than what we are seeing right now, $2,156. Okay, and what is the story behind the gold and inflation correlation? If inflation goes up, prices of gold will go up. If inflation goes down, price of gold will go down. This has been largely the case from the beginning of 2022 because the inflation started to perk up towards the last quarter of 2021. Okay, and the Federal Reserve only act on that inflation story. Remember, the Federal Reserve chairman used to tell us that inflation is transitory. Yeah, I think he means it altogether. And they only start to hike interest rate in March of 2022, synchronizing with the war in Ukraine. So we can see that there are two lines here. We have the yellow line, which is the price of gold, and the red line, which is the index measuring inflation. Okay, so we can see inflation go up, the price of gold go up. Initially, it did. Okay, and then it started to fall. So as the market falls, inflation goes down, gold prices went down. So that part, okay, up to October 2022 seems to be more or less in sync. However, we have this divergence here. Inflation continued to trend lower during the period from October 22 to January of 2023. Okay. However, gold prices starts to surge. Okay. And again, February 2022, 2023 to April 2023, you can see that inflation continues to go down. Prices of gold surge one more time. Okay. And lately is last quarter of last year, inflation continued to trend lower. We can see prices of gold starting to go up. This has not included the latest price because this is a monthly time frame. So I will get the latest. Right now, gold price is already above 21,000. Okay, so we can see that the price of gold has actually gone up. Has inflation gone up? No. Okay, so the story about gold and inflation being in a fixed relationship is not necessarily true. Okay. So how are you going to take advantage of your views in gold? What you can do is trade the COMEX. COMEX refers to commodity exchange. Now, within the CME group, there are other exchange that has been amalgamated inside the CME group. Okay, we have CBOT, we have the other New York Mercantile Exchange, which is NYMEX. We trade energy products, and of course, we trade commodities like precious metals. It is COMEX. COMEX stands for Commodity Exchange, and this is the premier market for trading gold. When you trade gold, you have to understand there are two gold markets. One is the futures market in Chicago, like COMEX, for example. The other one is what we call the LBGT, okay, London Interbank Bullion Market. Okay, so that market is trading cash, spot gold. Okay, well, in those days, when I was a gold dealer, we used to call it the local London gold. Local is a Latin word for delivery in. Okay, so delivery in London is the cash market. So London trade the bulk of all physical gold. Then all the hedging is done in COMEX. In terms of volume traded, COMEX has much higher traded volume compared to London. Okay, because this is definitely a hedging instrument. So COMEX came out with a micro gold futures. Okay, because again, gold prices has gone to $2,000. When I was trading gold back in the late 1980s, okay, gold prices was in $300. Okay, it gone up almost tenfold. Okay, so we can see that prices has they have to come out with new offering to make sure that it's still be accessible to retail investors like you and me. Okay, so the symbol is MGC. GC is the actual symbol for the regular gold contract itself. Now, M is basically the symbolizing micro. So this one is 1/10 the size of the regular gold contract. The regular gold contract is 1,000 troy-ounce. This one is only 10 troy-ounce. Each point movement every is $1, and the trading hours as of now until Sunday is still going to be these trading hours. Remember to cater for 1 hour earlier come Monday. And these are offered in regular even months. Okay, we have February has just expired. Right now we are trading the April contract. After April, we have the June contract and August contract, so on and so forth. Okay, and unlike the trading of equity index, it's actually deliverable. What it means, if you hold a long position all the way to the last trading day, you are obliged legally to actually take delivery. Okay, and this is a big deal. Do not end up taking delivery or having to deliver, because that is not what you are trying to do. You're trying to make the price difference between the whatever you sold and whatever you sell. So you have no interest in the physical. So make sure they don't trade into the last trading day. So the termination of trading is very important. The third last business day of the contract month itself is the last day. Do not trade into the very last day, because there will be no counterparty for you to be very aware. So the margin is actually quite affordable. $830 for carrying a trade overnight, and $35 for overnight trade, for intraday trade. So you can see the volume is not as fantastic as the equity markets, which trade into a million lots per day. Here, on average, we get about, of late, we're getting about about 80,000 lots traded. Very, very, very respectable. And open interest is maybe about less than half. Okay, and maybe about 3,003. Okay, so as of we can see that of late people are holding position. Open interest has been climbing since the beginning. What this is January. Since January, we can see that the open interest has been climbing. So people has been accumulating gold position for the last 3 months. Okay, so this blow up in terms of their price in gold is no surprise. Now, this is what I call the daylight saving starting Sunday. Okay, this will last all the way to November, and then it will revert back to normal day trading. So starting on Monday, the market will open 1 hour early. Okay, and this is actually a legacy of the last oil shock happened in the 1970s, where the OPEC actually punishes the United States and actually sanctioned what they don't call it sanction, they call it embargo. They refuse to sell oil to the United States. In those days, US is not a major oil producer, so that was the first time the American suffered a sanction, and whereby the price of gasoline goes up. Price of oil used to be low $3, and it went up to $12, and they were all screaming murder. Okay, now we are at $80. Crazy. So we have to go a long, long way, right? So in order to save money on petrol and electricity, because it's summer, right? So summer, the daylights are longer. They say, okay, let's make use of this summer. Let's don't turn on the aircon, don't turn on the electricity for 1 hour. You can save the 1 hour of electrical bill. So that was the legacy of a daylight saving. Okay. So if you need more information, you can actually go to CME website. They have a ton of resources. This is just one of them. Okay, you can go and do your own research or look at what the analysts are saying. You can look at the commentaries yourself, and you can go into this website and register an account, and you can actually do mock trading. You can actually do a demo account, and you can actually trade. We call it the trading simulator. And of course, you can go for lessons. Now, before you actually trade, make sure you arm yourself with the relevant information and knowledge before you click on the market. And this website has everything that you need. Okay. And then if you need to practice your view, you can go and open up a trading simulator, and they will actually allow you to trade as if it's a real account. Okay. So this is a very useful resource. Questions. I will take questions from now onwards. I've overshot my allowance. Have I? I used up 1.5 hours exactly. So now we will be doing the Q&A, and I'll be more than happy to take your questions.
Right. Okay. Thank you, Mr. Daniel. Okay. Okay. I have a question from Mr. Tenvi. Okay. On an average, how long after rate cut has the economy taken to get the recession status?
Okay, if we are looking at a May or June first cut in interest rate, because we have to look at those possible months in which the Federal Reserve may finally be cutting. The latest, like I said earlier on, for the Federal Reserve to cut is actually June, because August, the presidential election will be in full swing. Okay, and in order not to sound like the Federal Reserve is actually doing a rate cut to support the incumbent, they have to do it earlier. So the last month for them to cut is actually June. It may start to cut in May. And personally, I think May, by the second quarter of this year, we will have numbers that show that US economy is not as robust as what we have seen last year. So I do expect a recession. I do expect a reason why the Federal Reserve may have to accelerate rate cuts by then. Okay, so that period is somewhere in the middle of this year. And as to when the first rate cut happened until recession set in, there's going to be a delay effect. Okay, possibly, like I said, the real impact of a recession will come after the presidential election. But numbers coming out for second quarter onwards is going to be very telling that the US economy is actually slipping. Okay, they are not growing at the fast rate that we've seen in Q3 or Q4 of 2023.
I see. All right. Thank you, Mr. Daniel. Okay. The second question is, Which assets are the Chinese taking the liquidated funds from sales of treasury bonds?
It is not binary in the sense they don't just unload the treasury, take the US dollars. I think a good part of that liquidation of treasuries has gone back to China because China is fighting a deflation right now. You can see when you look at the A shares in China, they have all been falling, right? And it's about the only major equity market that is falling, where the rest of the world are charging into fresh all-time high. We have Indian equity markets at all-time high. We have the German stock market at all-time high, despite falling into a recession. The same thing happening in Japan. Japan Nikkei 225 is at record high, a 35 years high, just when we knew that the Japanese economy has slipped into recession. So every equity markets around the world, the major one, are all into record high territory. The only exception is China. So I think a lot of all these dollars that they get their proceeds from the sales of the US Treasury has gone back to China to support the local markets. And to a large extent, China is also pivoting towards the purchase of gold. Now, last year, China made a lot of headlines when they buy an enormous amount of gold. Okay, so a good portion of that dollar proceed has also gone into alternative assets such as gold. Okay, and a lot of people are saying that China is getting ready to revalue gold after this trend in which the whole world is trying to de-dollarize, meaning to say they don't want to hold on to dollar assets or even the dollar itself. So the next best thing for them to do is to buy tangible assets, which is gold. Okay, so yes, a good part of those proceeds from the sales of treasury has gone back into China, okay, to support the local market as well as to pivot into alternative assets like gold.
Alright, the next question would be, what is your personal opinion of where gold price can go up to? And how about silver price?
Okay, this is very interesting. Since you asked, I will tell you. Okay, my personal view is gold is going to be way more than what we are seeing right now. If I give you a ballpark number, double, okay, double of where it is right now, it will not be too far-fetched. I'm not saying it will happen tomorrow. It will happen over a period of time. Okay, over the next 10 years, we can see there's going to be a lot of major paradigm shift in the global financial system. Okay, and gold will feature very prominently because we are going into that cycle in which geopolitics is going to be uh, quite a messy thing that we have to deal with. Okay, gold prices goes up in terms of uncertainty. I grew up knowing about the boat people in Japan, the boat people in Vietnam. Now remember, just after the war in Vietnam, a lot of Vietnamese wants to get out of the country, and the only way they can buy a passage, okay, in a rickety boat, a sampan, is to smuggle themselves out of the country by producing gold. So gold, okay, has always, as far as Asian is concerned, we have this affinity to gold. We don't have to explain how valuable gold is. Every Asian can relate to gold because gold has always performed that assets in which we will go after in time of real uncertainty when your life is at stake. Because when you talk about real estate, when you have war in your country, you can't take your property along with you. Okay, we saw that during the Arab Spring where the refugees are all running for their life and they have to leave behind all their property markets. Okay, they have to leave that behind. The only thing they can bring along is actually something physical, tangible. Okay, and gold has always been the case. The last time I see something that people actually had to pay for their passage in gold was during that insurrection in Jakarta. Okay, I remember that was back in 1989. Okay, and there was this campaign against the Indonesian Chinese. These people are born, they are naturalized Indonesian. But when when President Suharto was brought down, okay, they took their anger on the Chinese community, and those Chinese, in order to get out of Jakarta, have to pay their way in gold, okay, to get to the airport, to get a flight out of Jakarta International Airport. So that was the last time I saw gold performing this role as the asset of last resort. So that was then. Okay, so I believe if this world is going into headlong into wars, and we are beginning to see the war in Europe is definitely not going to die down anytime soon. Okay, in fact, I think I have reason to believe it will escalate. And if it escalates together with the ongoing war in the Middle East, and God forbid if we have another one in Asia, then gold prices is going to fly to the moon. Okay, so I'm saying that gold prices may easily double from where it is right now. Based on this idea. Okay, not so much based on inflation, based on other economic measures. Okay, I think based on pure geopolitical tension. Silver, okay, silver has been underperforming gold relatively. When you want to look into whether to buy gold or buy silver, look at the gold-silver ratio. The highest back in 2020 when the ratio was above 100, meaning to say it takes uh, uh, how much silver do you buy the same ounce of gold? Okay, so you basically take the price of gold divided by silver. You get the ratio, right? And then the higher the ratio, it means silver is cheap. You should buy silver. If the ratio is low, then it makes sense to buy gold. So look at the gold silver ratio to give you a sense. Right now it's about 80. Okay, neither up, neither very high, neither too low. Okay, so but you can see that as this index goes higher, it will make sense to own more silver than gold. Currently, silver has been underperforming. It's called a poor man's gold. Okay, but silver actually have industrial application. So is gold, but silver more so. Okay.
All right. Okay. Talking about gold. So the next question will be, what is the difference between London gold and COMEX gold?
Okay. Just now briefly I did mention, right? London trades spot. Physical gold are delivered in London, whereas COMEX gold, very few actually end up in delivery. Okay, and at the beginning of pandemic, remember all the borders were shut down, and for those people who bought gold in London, they want delivery, but there was no flight out. So that created a situation in which they couldn't hedge properly their gold position in COMEX. Okay, so there was a lot of people demanding delivery in COMEX. Now, COMEX warehouse are not built for massive delivery because historically, COMEX gold prices do not end in delivery. They are more for speculation. Whereas those who really want an actual gold will go to London to buy and sell because you can buy in bulk. Okay, of course, another center has actually developed in Shanghai. Shanghai is mimicking what the LMA is doing. Okay, the London Bullion market is doing. So basically, you have another alternative in Asia via Shanghai. Okay, so that is the difference between the London market as well as the COMEX in New York. Both are gold, but both are very different in nature. Physical golds are transacted in London. Futures markets are meant for speculation and hedging, and they do not end up mostly in deliveries. The only exception was during the pandemic, whereby people cannot get their hands on gold because simply there was no flight available flying.
I see. All right. Okay. Okay. There's another question, right? Where someone would ask for your opinion. Will there be a federal cut soon?
You mean rate card? You mean?
Excuse me.
I think there will be
Yeah,
a rate
federal
card.
rate cut. Yes, correct. Mm-hmm.
Yeah, I think there will be a rate cut. Like I said, the earliest I think, or rather the latest they have to cut will be in June. Because by then the data will show that US economy is slipping. The so-called soft landing narrative is a lot of hot air. Okay, I think we probably will see something quite ugly. See, one of the reasons why I think the US GDP numbers is, I wouldn't say cooked, but I think the reason behind the GDP being so strong in Q3, Q4 is because because you tie in with the budget deficit, the US government is actually growing. the tax collection is not enough to pay for the spending program. And one of the reasons why the GDP is so strong in Q4, Q3 and Q4 is because the government has actually expanded the size of the government. They are employing more Americans in the federal and the state government. Okay, and that actually boosts the GDP numbers. And that's also one of the reasons why the unemployment rate do not show up as more Americans been laid off. That's because most of these people has been employed by the state and federal government. That makes the economy looks bigger, but they do not produce. Now, when you work for government, if you are a civil servant, okay, you work for the government, and if the civil servant civil service expand, it become a burden on the government because every year they will have to expand more, okay, to keep the size of that civil service, okay, and they do not produce anything of economic value. So that's a big difference. If the GDP is supported by real growth, by looking at the manufacturing manager index, the index is going higher because demand is there, and employment catch up because factories need more workers. That is all well and good, but if it's not supported by that, and instead it's supported by more people being employed in government's payroll, that is not a good thing. Okay, eventually it will show up. Okay, right now I think those numbers that we are seeing in terms of the non-farm payroll, the unemployment rate, and the GDPs are tied in very neatly with the expanded budget deficit.
All right, Mr. Gang. Okay, can get another question, right? Okay, Bitcoin hits almost all-time high also, all right? Does crypto market got any directly impact toward futures market?
Of late, this morning I saw one article. They say more and more it looks like gold and Bitcoin has a direct positive correlation. Meaning to say gold prices goes up, Bitcoin goes up. There was no visible correlation between Bitcoin and the price of the what you call it traditional asset class. But beginning to see that now there was a period of time whereby Bitcoin prices moved in tandem with equity markets. So right now we are in a very unique situation in which almost all assets are going up. We have equity market going higher, record high. We have gold at record high. We have Bitcoin at record high. We are also beginning to see the bottoming out of oil prices. And if we have looked at commodities, have you seen cocoa prices? Cocoa prices has been on steroid, okay? And this is a very unique situation where everything seems to be going up, okay? So you ask me whether there is any correlation. I won't say there is lasting correlation. I think it all depends on the period of time. But however, there are people are looking at gold prices and Bitcoin right now and say, hey, these two are moving in tandem with each other. But I think Bitcoin is moving on a different narrative. Okay, my take on Bitcoin is this: it's not something that I will buy and hold. I don't invest in cryptocurrency. There are times I get paid in crypto, and that's how why I end up having some crypto. But I don't buy and hold them. Now the way I look at it is that in the there was a period of time after Second World War, the dollar is pegged to gold, and then it becomes very inconvenient because they cannot print as much. Every dollar they print has been backed by $3.50 of gold. Okay, so President Nixon in 1971 actually delinked, okay, gold from the dollar. And 2 years after that delinking, they found a new asset to latch on. Dollar is linked to crude oil. We call it the petrodollar. Okay, and that has gone very well since 1973. Okay, now we are 50 years later, we are looking at the situation. We have a new situation whereby there's a global trend to de-dollarize, and crude oil sellers are no longer accepting only exclusively in dollar for payment. They are beginning to accept other currencies like RMB. Okay, so you can say that there is this trend in which the dollar may not necessarily be pegged, be priced in dollars, and that will have a monumental impact on the value of the dollar. Okay, so now I think the dollar needs to latch onto a new asset class, and you'll notice that leading to the approval of the bought BTC ETF licenses back in January 10th. Okay, before that, the only place you can buy Bitcoin is through exchanges like Binance or Coinbase. You notice that they have been trying to do away with these traditional exchanges. The world is climbing down on cryptocurrencies, crypto exchanges, and they only allow you to buy Bitcoin through the ETF in the States. So what they are doing now, right now there's about, I believe, less than 10 Bitcoin ETF license holder. And you can see the inflow that comes into this ETF. These are not your regular people buying Bitcoin. These are the institutional players. And when the institutionals muscle into this space here, definitely the price of the asset is going to go way, way higher. Okay. And yes, prices have hit $69,000 of late in Bitcoin, but I think it's going to be worth a lot more, purely because they need to suck in all the excess US dollars circulating outside of the United States. The US is between a rock and a hard place. Okay, they have a major debt crisis. Nobody want to buy the treasury bonds, so they need the money to come back. How do they encourage the dollars circulating outside the United States to come back? It's just to promote an asset class. Okay, this is my theory, okay, whereby I think they want to basically encourage all the inflow of dollars back into the United States. The only way you can buy Bitcoin now is through the ETF, and the only currency that you can use to buy Bitcoin is dollars. So what you get in return is Bitcoin, okay? And because it's ETF, you do not necessarily own the Bitcoin itself, okay? It's through a ETF. So this is my idea. I think Bitcoin is, and by extension, maybe Ethereum as well, all the major coins is going to go to the moon, okay? At some point, they want to take in all the excess dollars floating around the world. Okay, this is just a theory. It's not based on facts.
All right, no worries, Mr. Daniel. Okay, there's another question, right? The last question: who usually trades in London markets and who in the Comet markets? Mr. Kanver is referring to market participants in gold.
Okay, very good question. Who buy and sell in London is obviously the big boys because they deal in bulk. Okay, central banks, if they want to buy gold, they don't go to COMEX to buy. They always buy in the wholesale market, in a cash market, whereby large size transaction can go through. Okay, now the London market is not as transparent. They are actually quite open. In the olden days, the way they deal with gold, if you heard of this thing called the PM fix, gold price is fixed twice a day. That means gold price is agreed among all the bullion dealers in London twice a day. And the PM fix is going to be the price in which all buyer and seller transact at the same price, no spread. Okay? And that allows for large size transaction, which is very different from the COMEX gold prices. They are very transparent and they flip and flip and flip throughout the entire trading hours. So you can see that the pricing is a lot more transparent compared to those pricing in London because it's fixed by the bullion dealers. Okay, just a few old gentlemen. In the olden days, they were like, gather in the room, a few bullion dealers, and they decide, okay, who needs to buy what and what price. Let's agree on the price, and all the buying and selling internationally would occur at the price. Okay, which is very, very opaque. Okay, which you can't see where the real dynamics is. You can't analyze the pricing basically. Okay, whereas it's very different from COMEX gold, which is actually moving up and down the entire day. Of course, you can trade the spot gold prices through a CFD contract. Okay, you can do that as well, but that is beside the point. When you talk about the difference between COMEX function and the London market function, there are two different cattle altogether, but both deal in the same underlying commodity, but in a very, very different way. Okay. The retail investor, the speculator will trade COMEX. Okay, they don't trade in London.
All right, thank you, Mr. Daniel, for answering all our questions. All right. All right, before we all go, I would like to introduce. Okay, I would like to introduce Apex Academy. All right, most of our daily highlights and we would actually upload our reports in the morning and also in the afternoon. How do you enter this? Just simply type academy.apex-etrade. When you enter this page, come to derivative. Again, you can see our latest video would be here on the right side, and you can see most of our research report would be here. You can get up to date based on our daily reports in this page. Alright, that's about it. Alright, once again, thank you, Mr. Daniel, and everyone who attended our seminar today. I wish you all have a very good night. Alright, thank you. Alright. Okay, there will be also a reminder. Next Thursday, there will be Transaction to Futures Part 2. Please join our Part 2 seminar for further informations. Alright, thank you everyone. Have a pleasant night. Good night everyone. And thank you to Mr. Daniel again. Alright.
Thank you very much. Good night.
Alright, good night.